All right, we begin the broadcast right now.
Great. Hi, good evening, everyone. Thank you for joining our Investor Day series, where we'll be talking about risk and opportunity in Trump 2.0, a global perspective. Just a disclaimer, this webinar is solely for education and informational purpose only. This is the outline that we have for today's webinar. So my name is Kayan. I will be going through the current opportunity of BR Capital, and my colleague Wing Long from Investor Development will be talking about our secondary market trading. And also tonight, very honored, we have our guest speaker, Mr. Kevin Tay, from Bond Pricing Agency Malaysia, BPAM. He will be going through about the risks and opportunity in Trump 2.0, a global perspective, and then followed by the Q&A section. So welcome to BR Capital. BR Capital, we are a digital debt fundraising platform, a joint venture between Bursa Malaysia and RAM Holding. We are registered with the Security Commission Malaysia. So we facilitate fundraisings for the issuer with a minimum issuance size of 5 million. And the notes are actually rated by RAM. And then for investor, we welcome all investor included institutional, sophisticated, retail. With you guys can invest with as low as 100 ringgit in all of our live campaign. So current opportunity. Currently, we have a live campaign hosted on our website, which is Project Everest Tranche 2, offering a profit rate of 6.5 per annum with a tenure 1 year. So just current opportunity. Currently, we have a live campaign hosted on our website, which is Project Everest Tranche 2, offering a profit rate of 6.5. Sorry. So just a little bit background of the issuer. The issuer is a wholly owned subsidiary of EP Manufacturing Berhad. The company is actually listed on the main market of Bursa Malaysia. They are a tier 1 vendor to Honda Malaysia, and was awarded the best supplier for 2 consecutive years between year 2022 and 2023. They are also appointed as a contract vehicle assembler for GWM and BAIC in January or April 2024. So the issuer has established a new vehicle assembly facility for assembling the ICE vehicle, in energy efficient vehicles, electric vehicle, and also the commercial vehicle. So if you are interested to become our investor, you can actually visit our link here, brc.bursamalaysia.com, to register yourself and start investing in this particular campaign. So thank you for your support. We have actually successfully closed 4 campaigns previously. The total size of this 4 campaign is actually 20 million. So you can see we have listed and unlisted companies that have come to our platform to raise funds. You can see here we have Project Coin Tranche 1. They are one of the Malaysia's largest laundromat operator. And then we also have Project Everest. And then we have Project Eco that we have previously closed. Yep. So I will pass to Wing Long, where he will be going through the secondary market and how you guys can trade. Thank you. Over to you, Wing Long.
Thanks, Kaya. A very good evening to our valued investors and participants of this session. I am Wing Long from the Investor Development in BR Capital. You've just heard Guyan share the past campaigns. So what happens if you have missed the boat and you really wanted to buy the investment note after the campaign subscription stage? Or if you've subscribed for the previous campaigns and now you've seen the new campaign with a 1-year tenure at an attractive 6.5% yield, you're really interested in subscribing for that campaign, but your funds are tied up. What can you do about it? Well, we have introduced a secondary market at BR Capital as a potential solution to this. Our secondary market, also known as BR Capital Marketplace, allows for the buying and selling of investment notes that were issued through BR Capital's platform. While our trading is not as vibrant as equity markets or other markets, there have been some trading activities previously, and all registered investors are welcome to put in your buy and sell orders if needed. This is a snapshot of our secondary market webpage. You have to click on the BR Capital tab here to access the secondary market. After which there are a variety of features you can explore. The main thing is that you want to probably click the trade button, the second trade button over there. So once you hit the trade button, there is now this pop-up for you to key in your order. You can select a buy or sell order by clicking on the top. Remember that your wallet will need to already have sufficient funds before you can key in the trade. Now, some of you may further ask, before I buy an investment note, how do I know what's a fair price or valuation for me to key in? Well, as an advocate for pricing transparency at BR Capital, we have included this BPAM reference range to inform our investors on what a fair price range to input. Simply select the investment note you're interested in on BR Capital Marketplace and scroll down to this indicative BPAM reference pricing. For those of you unfamiliar, BPAM is the only accredited, only registered bond pricing agency in Malaysia with the SE, with a mission to provide consistent and systematic bond fair valuation as part of the national infrastructure of the Malaysian fixed income market. With that said, let me now introduce our guest speaker from BPAM. Mr. Kevin Tay, a market and economics expert with over 16 years of experience in derivatives, fixed income valuation, and economic analysis. His responsibilities at BPAM includes the valuation of Malaysian bonds and sukuk and macroeconomics research. Welcome, Kevin. Now over to you.
Good evening, ladies and gentlemen. I'm Kevin Tay. I would like to thank BR Capital for inviting me to give a little talk on the risk and opportunity in the financial market. In view of the second Trump presidency, in fact,
Just give us a few minutes. We're having some technical issues.
Can you see my screen? Hi, can you see my screen? Okay, sorry, I will start again. Good evening, ladies and gentlemen. I would like to thank VR Capital for inviting me to give a little talk on the risks and opportunities in the financial market in view of the second Donald Trump presidency in the US. In fact, Trump has created headlines after headlines with regard to his policies since day one he took office. Investment is all about the politics and economy. So to be successful in any investment, we need to know the politics as well as the economy. Without further ado, let's get started. Donald Trump's MEGA, or Make America Great Again agenda, is a broad vision focused on nationalism, economic protectionism, and conservative values. It emphasized strict immigration policies, including border security and mass deportations, aiming to put a stop to illegal immigration. On energy, Trump has declared a national emergency and signed executive orders to boost fossil fuel production, reopen previously protected areas, and roll back environmental regulations to expedite energy projects. On trade, Trump advocates for tariffs on China and other nations to boost American manufacturing. Okay, in finance, he has signaled support for crypto and demanded rate cuts from the Fed, while opposing DEI, which stands for diversity, equity, and inclusion policies, calling them woke and inefficient. His rhetoric champions common sense governance, emphasizing economic growth, deregulation, and America First policies that challenge globalization and left-wing ideology. Last one is the DOGE, the acronym for Department of Government Efficiency, led by Elon Musk to identify wastage in the federal government. It aims to halve the $2 trillion deficit and to downsize the government workforce. In his second term, Trump has intensified his protectionist trade policies by imposing significant tariffs on key trading partners. On February 1st, he signed executive orders enacting a 25% tariff on all imports from Canada and Mexico, and a 10% tariff on Chinese goods, aiming to address trade deficits and stop illegal immigration and drug trafficking. These tariffs were initially set to take effect on February 4th, but were pushed back for 1 month after Canada and Mexico agreed to enhance border security measures. On February 10, Trump announced a 25% tariff on all steel and aluminum imports, effective March 12. These moves eliminated previous exemptions and aimed to bolster domestic metal industries. The aim is to stop countries like China to use other countries to export steel and aluminum products into the US. On February 13, Trump proposed reciprocal tariffs, intending to match the tariffs that other countries impose on US exports. This policy seeks to address perceived trade imbalances, but risks escalating trade tensions. With a stroke of a pen, Trump has effectively ended the globalization agenda. Additionally, Trump has threatened a 100% tariff on BRICS nations if they pursue a new currency to challenge the status of the US dollar as world reserve currency. Economists warn that these aggressive tariffs could disrupt global trade, lead to higher consumer prices, and potentially trigger economic recessions in affected countries. All in all, it is estimated that average of 20% tariffs imposed on all imports into US will generate over 300 billion in revenue annually, or about 3.3 trillion over the next decade. Now, let's look at the cost to consumers and the effects on household income. We know that consumers are the ones who pay the ultimate cost of tariffs. A study on previous Trump's trade war shows that every American household has to bear around $250 per year between 2018 and 2023. The bottom 20% of the income group could experience a reduction of about 4.2% in after-tax income annually due to the tariffs. Anyway, all income groups are expected to see a decline in after-tax income with Trump's tariffs. Next slide is on the tariffs and the inflationary pressures. While the proponents argue that tariffs could boost domestic manufacturing and jobs, critics warn it may worsen the inflation. Tariffs will always lead to higher prices for imported goods, increasing costs for businesses and consumers. This could pressure the personal consumption expenditures, or PCE index, a key inflation gauge tracked by the Federal Reserve. If tariffs raise production costs and consumer prices, the PCE could rise, potentially complicating the Fed's effort to manage inflation and stabilize the economy. Deutsche Bank has updated inflation forecasts, indicating that a 25% tariff with a 50% pass-through rate to consumers could raise PCE inflation by 80 basis points, and a 75% pass-through could add 110 basis points. Recently, inflation measures like the CPI and the PPI have started to reverse their downtrend to inch higher. This rise on both CPI and PPI could complicate efforts to control inflation by the Fed. The Fed would like to cut interest rates, but the inflation remained elevated and it hasn't dropped to a Fed's target of 2%. On the other hand, Trump is demanding the Fed to cut interest rate, as well as authorizing Doge to perform an audit on the Fed itself. In view of the rising inflation expectations due to the tariffs, the Fed is now less likely to cut interest rates. The current forecasts expect the first cut this year might occur in May, with a 21% chance that there will be no cuts at all this year. Current consumer inflation expectations indicate a projected price increase of 3.3% annually over the next 5 to 10 years, the highest since 2008, up from previous expectations. In his second term, Trump has implemented multiple strategies to reduce crude oil prices, focusing on both domestic production and international diplomacy. On domestic front, on February 14, Trump signed an executive order establishing the National Energy Dominance Council, aiming to boost US oil and gas output. These initiatives include granting conditional approval for a significant LNG project in Louisiana and reversing previous bans on offshore drilling. These measures are designed to increase domestic supply and consequently lower the energy prices. Concurrently, Trump has urged the OPEC, particularly Saudi Arabia, to reduce oil prices. In an address to the World Economic Forum on January 23rd, he announced plans to request that OPEC increase production to bring down prices. However, OPEC has maintained its existing production plans, focusing on long-term market stability rather than immediate price reductions. Trump's strategies also involves leveraging oil prices to influence global events, such as the Russia-Ukraine war. By advocating for lower oil prices, he aims to reduce the Russian revenue from oil exports and thereby pressuring Moscow to seek peace. This approach underscores the administration's use of energy policy as a tool for broader geopolitical objectives. Oil prices account for approximately 8% of the CPI. Fluctuations in energy costs directly affect other components such as food prices. According to a study, a 10% decrease in oil prices may result in a 0.2% reduction in inflation. With the latest CPI at 3%, the oil price has to drop as much as $50 in order for the inflation to reach the Fed's target of 2%, which is a bit far-fetched at this moment. Okay, since Trump's presidential election victory in November, the US stock market has experienced a significant inflows and upward momentum. Investors have poured nearly 140 billion into US equity funds, driven by expectations of tax cuts and regulatory reforms under Trump's administration. This optimism has propelled major indices to record highs. Despite concerns about potential inflation due to proposed tariffs, investors expect that the pro-business policies, including tax reductions and deregulation, will stimulate economic growth and corporate profits, offsetting potential inflationary pressures from tariffs. Additionally, strong earning reports have boosted investor sentiment, especially those involving in the AI field. Since the Federal Reserve's policy pivot in September last year, US Treasury yields have experienced a notable surge, especially in longer-term maturities. In September, the Fed lowered the benchmark Fed funds rate by 50 basis points, bringing it to between 4.75 and 5%. Contrary to typical market reactions, where rate cuts lead to a drop in long-term yields, the 10-year Treasury yield did the opposite, increased from approximately 3.6% in September to around 4.5% recently. Reason for the surge is because, besides the inflation expectation, the market believes there will be tax cuts under Trump, and with that, higher budget deficit and bond issuance. On the demand side, the current Fed's reduction of its balance sheet, or quantitative tightening, or QT, has decreased the demand for the US Treasury. Okay. Subsequent to Trump's victory, both the US dollar and gold prices have experienced simultaneous increases, a divergence from their typical inverse relationship. The US dollar index has strengthened, while gold price have surged to record highs, approaching the 3,000 per troy ounce mark. The tariff has introduced volatility and uncertainty into global markets. This environment prompts investors to seek safe haven assets, bolstering both US dollar and gold. The dollar benefits from its status as a world's reserve currency, while gold is traditionally viewed as a stable store of value during turbulent times. As of January this year, the US and China are experiencing contrasting economic conditions. The US is grappling with rising inflation, while China is facing persistent deflationary pressures. In January, the producer price index in China declined by 2.3% year-over-year, marking the 28th consecutive month of factory price deflation. While the CPI saw a modest increase, this was mainly driven by seasonal factors, such as the Chinese New Year spending, as underlying demand remains weak. Some of the key factors contributing to China's deflation include excess production capacity that led to sustained declines in producer prices, a prolonged downturn in the real estate market has dampened investment, and ongoing trade disputes, particularly with the US, which have negatively impacted export demand. Next, as of February, China's 10-year government bond yields have fallen to a record lows, recently dipping below 1.6%. This decline reflects investors' concerns about deflation and a sluggish economy. Some of the measures implemented by China's central bank include maintaining the one-year MLF rate at 2%, providing liquidity to financial institutions, as well as reducing the reserve requirement ratio by 50 basis points, releasing approximately 1 trillion yuan to encourage lending. Despite these efforts, the persistent decline in bond yields indicates ongoing deflationary pressures, and investors should be cautious on China's economic outlook. In recent years, China has adjusted its foreign exchange reserves, notably by reducing its holdings of US Treasuries while increasing its gold reserves. The reduction of the US Treasury aligns with China's long-term strategy to diversify its foreign exchange reserves and reduce reliance on US dollar-denominated assets. Between 2013 and 2024, China's US Treasury holdings declined by nearly $500 billion. On the other hand, China has been accumulating on gold. Between November 2022 and April 2024, the Central Bank of China reported consistent money increase in gold holdings. With gold share of official reserve assets has seen substantial increase as well. Holding more gold can increase confidence in Chinese yuan when it's used in the international trade and mitigate risks associated with potential US sanctions. Okay, as mentioned earlier, the US dollar has strengthened substantially while the gold price surged to record highs, which from a historical perspective doesn't make sense. Both of them should be inversely related. The surge in the gold price is mainly driven by economic uncertainties, including the imposition of tariffs by Trump, which have heightened demand for gold as a safe haven asset. As reported just last week, the Bank of England has difficulty in fulfilling physical delivery of gold bullions from London to New York. A notable price disparity has emerged between gold market in London and New York. Gold prices in New York has increased substantially higher than those in London, prompting dealers to transport gold bars across the Atlantic to capitalize on the price difference. As of December, the US M2 money supply reached $21.53 trillion, marking a 3.9% year-over-year increase and a 0.4% rise from the previous month. The increase in M2 money supply has a knock-on effect of driving commodity prices higher. Even if the US dollar begins to pull back, foreign investment in gold is set to rise due to the increase in M2 money supply. Okay, in July last year, during the Bitcoin conference, Trump unveiled his plan to establish the US as the crypto capital of the planet and a Bitcoin superpower. He emphasized the importance of having cryptocurrencies mined, minted, and made in the USA. Trump proposed creating a national Bitcoin reserve, transforming seized cryptocurrencies into a permanent national asset to benefit all Americans. This initiative aims to strengthen the country's financial position and assert its dominance in the crypto space. Venture capitalist David Sachs, appointed by Trump as the White House AI and crypto czar, is going to lay out plans to start working towards a regulatory framework for crypto. According to Sachs, getting legislation through Congress is something that can be done within 6 months. One of the first things he will be focusing on is a stable coin. And by the way, the price of Bitcoin has been on a tear since Trump's presidential election victory. It's currently stayed just below 100,000 US dollar. Okay, now let's look at the FTSE Bursa Malaysia KICI index. It has softened lately due to Trump's tariff threats. Market sentiment remains subdued as Trump's Middle East policy seems to go against Malaysia's stance. Purely from technical point of view, a dead cross has occurred in which the 50-day moving average has dipped below the 200-day moving average. This is considered as a bearish signal. Moving on, the 10-year MGS and US Treasury yield differential has become inverted since 2023, which means the 10-year US Treasury yield is higher than the 10-year MGS yield. That perhaps sums up the ringgit weakness in these 2 years. This trend will continue for a while unless US interest rates start to decline. Next slide is on the foreign holdings of MGS. Since the yield differential between MGS and US Treasury has become inverted, the foreign holdings in the MGS have also been coming down. This is expected as US Treasury securities are perceived to be far superior than our MGS. By January this year, the foreign holdings of MGS have declined for 4th consecutive month and its reading of 32.3% of the total outstanding was the lowest level dated back to April 2011. Okay. That's the end of my presentation. Thank you for listening.
Thank you so much, Kelvin. If the attendees have any question, you guys are welcome to put your question in the Q&A box now. Thank you. Okay, Kelvin, we have a question. There's a question said, what is BPAM in-house view on the OPR direction in 2025?
Okay. In-house view is BPR the OPR to be at 3% throughout the year, which means there's no changes.
Okay, there's also another question is, should there be a bigger allocation on fixed income asset in the Trump 2.0 for our portfolio given the expected increased volatility in equity?
Okay, thanks for the questions. I think in terms of portfolio allocation, it all depends on your risk appetite. So if you are a risk-averse person, I think 50% allocation between equity and fixed income is the preferred option. But if you are seeking for more returns and willing to take more risks, I think 80-20 or 70-30 in terms of equity to fixed income allocation is the one to go. It all depends on your risk appetite.
Okay, thank you, Kelvin. Another question is, what measure is the Federal Reserve considering in response to the rising inflation and how this will affect the economy?
Okay, I think Federal Reserve at this moment is all about cutting rates. But if the inflation start to inch higher, as I mentioned just now, it can keep going up. The Fed might reverse course and start to raise interest rate again, especially with Trump's tariff. It is expected Trump tariffs all in all will increase the inflation by around 1%. If there's a 20% tariffs imposed on all imports into America.
Okay, thank you. Another question is, are you expecting US market correction?
Everybody knows that the US market, the equity market is currently very high. So I think with Trump's tariffs, it can be coming down. So it can be a very difficult moment for equity investor at this moment. So you need to be extra vigilant especially on Trump's tariff. So I think it perhaps start to reduce your holdings.
Okay, one more question is, how about US-China trade war direction during Trump 2.0? What is your view?
Okay, I think the US-China trade war, the direction can only get worse from here. So just be prepared for the worst lah. Yeah, I don't think there will be any silver lining on this.
Okay. Another question is, how are US tariff affecting the global supply chain, particularly to China?
Okay, like it or not, the world factories is still in China. Okay. I think the false belief is that China, I mean the China labor cost is cheap, but actually that is not true. Everybody moves to China to produce their goods is because China has the best infrastructure and the logistic network. Okay, and also some, I mean, most of them already currently automated. So even if US doesn't want China's goods, so their consumer will lose out because everybody else will still rely on China's supply chain.
Okay, thank you. And also, what is your in-house view of USD and RY direction in this year? Can ringgit appreciate further in the light of US?
Well, in view of the Trump's tariff plans, I believe ringgit will stay around 4.4% and 4.6. I mean, sorry, 4.6 to 4.4 to 4.6 against the US dollar.
There is also a question, is gold better option now compared to stock?
I think if you are risk averse type, I think gold is definitely a better option. Okay, but if you are willing to take on more risk, stock is the one to go lah. But I think gold is the perfect balance between. I mean, it's a balanced bet between risk averse and risk on mode.
Okay, thank you. One question is, China is increasing its gold reserve, and what implication does this have for the gold market? I mean, your view.
Okay, China has been doing that for some time already. I think definitely more than 10 years already. So for me, it's just a political signal that they don't want the US Treasury and they prefer on gold. I mean, especially since China President Xi Jinping came to power, they started to do that. It's just a political stance that they prefer gold over the US Treasury, the US Treasury bond.
Oh, okay. So, so another question I would like to ask is, what measure is the Federal Reserve considering in response to the inflation, and also how this might affect the economies?
I think, if not mistaken, I have answered that. I mean, the Fed will definitely reverse course if the inflation is going higher from now, and if they increase their interest rate, right, the economy should be affected because everyone's likes the lower interest rate.
I see. And how are China deflationary trends affecting its monetary policy decisions?
Okay, if the China's deflationary trend persists from now, I think the China central bank will have to cut interest rate even lower from their current level. Okay, so China interest rate may stay lower for longer. So it's definitely opposite what is being experienced by the US.
Okay, and like in your house view, what are the potential global economics implication of China reducing the holdings of US Treasury securities?
I think I mentioned that also. It's just a political statement by reducing the US Treasury and increasing the gold holdings. It's just they have been doing that for some time already, like I mentioned just now. So it's just a political statement. Of course, if they keep on doing that, the gold price will sustain at current level, which means it's a kind of safe to invest in gold.
Okay. Do you think Bitcoin prices will go higher from where they are now?
Bitcoin is a very volatile instrument, so I dare not say what is the price of Bitcoin tomorrow. So it all depends on your holding power. So if you are very long-term investors, I believe a 1% allocation into Bitcoin may also help you. It all depends on your holding power, but it's a very volatile instrument or assets.
Okay. Another last question for you lah. If Trump can make both Ukraine and Russia to stop the war, what will be impacting the global markets?
I believe they are now talking to each other. The U.S. Secretary of State is now in Saudi Arabia talking to Foreign Minister of Russia. So if they manage to come up something positive to end the war, I believe the global market will be very positive on that, and the global market may go on full risk on mode. I mean, all the emerging market assets may rise higher.
Okay. Thank you so much, Kelvin, for being here with us tonight. Do you mind stop sharing your slides?
Okay, sure. Thanks, Kayan.
So thank you everyone for joining this webinar. If you are interested in our live campaign project Everest Tranche 2 that offer a profit rate 6.5% per annum for 1 year, you can actually scan the QR code or visit our website to register yourself as an investor. In the website, you'll be able to read through all the relevant documents about our live campaign. And if you have any question that you want to ask or after this webinar, please drop us an email at brcsupport@bursa.malaysia.com. Thank you so much for joining this webinar and good night.